Gemma Dale, welcome back.
Thank you for having me.
Well, it's going to be interesting here. You're going to tell me about 2024, how the year played out and what you guys are thinking about at NAB for 2025. But just to be clear, you're still the director of SMSF and Investor Behaviour.
Yeah,
at NAB,
still.
at NAB.
Yeah.
And you're the host of Your Wealth podcast. So, okay, let's just talk about 2024. This time last year, we were all talking about 2024 as being, I don't think your bank said this, but some other banks said up to 7 rate reductions in starting in about June.
Mm-hmm.
That was a year ago, and here we are, no rate reductions, and we're talking about the same sort of stuff. But how do the markets, investor markets that is, and let's just put property aside for the moment, just investor markets generally in terms of various investor products, gold, shares, equities, how do investor markets perform in 2024?
Yeah, it's such a good question because if you're not watching closely and you are listening to the headlines saying it's going to be a dreadful year, we're just going to have this catastrophic economic outlook because rates are so high and it's crushing the consumer and we know things are dreadful and it will just all be very painful for everybody. You may have missed the fact it was a superb year for investors pretty much across the board, putting property to one side. If you were in Australian equities, so I sit in the nabtrade part of the business, which is the share investing, share trading part of the business. If you're in Australian equities and you just bought the ASX, so you just bought the top 200 companies, yeah, absolutely. You had a great year, right? 4.5%, 5% dividend yield, market's up 8-9% for the year, depending on when you started. If you bought the S&P 500, which is the top 500 companies in the US, and we found more of our investors doing that over time, right? They had an absolute doozy of a year. It was beautiful, sort of up well over 20%. That was mostly driven by the Magnificent Seven, so the sort of 7 companies that have been driving most of the growth, and that was largely a lot of excitement about AI. And even with quite a few extraordinary things happening through the year, that appetite just didn't dim. We kept expecting those guys to kind of pull back a little bit. It was an incredible year for them. Gold was up, 30-40% in Australian dollar terms. Quite incredible across the board. Most people, and if you were holding cash and term deposits, which is where people tend to sort of hold their fixed income. They don't tend to hold bond portfolios specifically, but more term deposits. You're getting a decent yield on your cash. So most of your portfolio had a great year.
So is that the reason why some parts of inflation appear to be stubborn, because the investor market was making a lot of money, and as a result of that, and they felt quite comfortable. They weren't sort of seeing a lot of losses, therefore their risk appetite was sort of fairly buoyant. People were prepared to spend at some levels of the marketplace.
I think that's very true. We know there is a wealth effect. People feel wealthier even if it's just in assets they haven't actually sold, right? So they haven't crystallized any cash or anything. But particularly older people, and we've seen this data cut beautifully, older people who own assets, so they have housing, they have shares, they have other investments, they've done extraordinarily well. And it's not just that the assets are going up in value, but the yields are really good on those as well. So they've actually found themselves in the extraordinary position of, even though things got tighter for retail, for spending in so many ways, particularly one group doing really well and still spending quite nicely.
So, is that different to what normally happens in high interest rate environments? Are we seeing some, let's call it structural change?
I think a structural change is such a good way to describe it. We have an issue now where economists for years have talked about a third in the Australian population, where you have a third of the population renting, a third of the population with a mortgage, and a third of the population who own their homes outright, and they tend to be retirees. And retirees for a long time didn't have a lot of cash. They didn't have the superannuation system to support them. So they were fairly constrained in their spending. They didn't have a huge amount of money to live on for the rest of their lives. And now you've got a really different situation where you've got a much larger group of renters. You've got a fairly sizable group of people who own their homes outright, and they have a lot of other assets. And then those in the middle is a smaller group with mortgages, but the mortgages are way higher than they've been historically, and they're really getting squeezed. So it's a really different cut to what it was 20, 30 years ago, and definitely 50 years ago.
And would you put that down to the group who own their own home, let's call them over 55s, and some of which are retired. Would you put that down to the guaranteed super that I think it was Paul Keating introduced in the mid 90s? Is it because those people they just get right now? They'd be like, it's like 30 years ago. He introduced it when they were 30. They're now nearly 65. Those people are reaping the benefits of that superannuation scheme.
That is definitely part of it. I mean, there's a whole variety of other things which you're very familiar with. There's a lot of tax opportunities attached to investments that are not available to those who are wage earners. And they made sense when you assume everyone was able to buy a home and eventually become an investor. But when you look at a category now where you go, a lot of these people will never own a home and will never have the opportunity to become investors and homeowners at the same time. You end up with those who are investors and homeowners doing extremely well and people not able to kind of crack that challenge. So there are lots and lots of tax and social security incentives for homeowners that don't exist for those who are not already in that category. And the superannuation scheme makes perfect sense if you want to ensure the population is not going to be dependent on the age pension when they retire, but it has also accrued a lot of tax benefits to a small group of people.
So who's losing? Is anyone losing out on this in 2024 and maybe 2025? Who's losing out?
Look, renters are the ones who are struggling the most. So we know even though mortgage holders have found it extremely difficult over the last little while, if they're relatively new mortgage holders. Worth noting that, and the RBA has published its data multiple times, there is also a third in the mortgage category where people who've had mortgages for a long time tend to be 2 or more years ahead in their repayments, and they had an opportunity to get way ahead when rates were really low, so they're really doing quite well and they're happy to just run down their mortgages over time. You've got a group in the middle who are okay, and then the people who had to borrow at low rates but they spiked really quickly but had to borrow very large amounts to buy very expensive houses, they've really struggled. So the mortgage category, there are winners and losers, and renters are the ones who found it most difficult though, because rents have accelerated really rapidly and they don't have other assets to rely on.
So what would you say then to renter market, and like some of these people just started working, so it's difficult for them, but what would you say for renters who want to achieve the great Australian dream? So how do they can't touch their super. How do they get a start, or how should they manage their expectations and their aspirations for one day owning a home, no matter where it is, like mum and dad did in Australia? What should they be doing in terms of maybe saving for a deposit?
Yeah, so saving for a deposit is everything as step one. And there is the real difficulty that obviously with rising cost of living, you may not have a lot of surplus cash flow. But doing whatever you can to get yourself some surplus cash flow, to find some savings in a fairly difficult environment, is going to be really important. And I'm not even going to begin to pretend that things were easier back in the day, because there's nothing more offensive, I think, if you're a young person than hearing that. But, those of us who took on second jobs or weekend jobs to just earn that little bit of extra money in order to put some money away, that did happen in the past and it happens now. And it is one opportunity to think, if you're finding that you can't make ends meet with your current salary or your current income, other ways to earn money perhaps as a way to put some aside, making sure that you're deliberately paying yourself first and that you are getting the best interest rate on your cash. Not taking undue risks is another one. I think one of the challenges...
Crypto.
Yeah, one of the challenges for young people is you hear these amazing stories about people who just did exceptionally well in some fairly speculative assets, and you want to chase those. It's amazing when it works and it's horrendous when it doesn't. So perhaps don't take undue risks if you don't have to. It might take longer, but it also might be more likely that you get the outcome you're after.
And it's also like a 1 in 1,000. So the 1 in 1,000 do well. 999 don't tell you about the story because they don't do well. You just don't want to be one of the unlucky statistics, which is the majority by far, overwhelmingly by far. So let's look at 2025. It can't keep just going on and on and on forever. Good markets, good property markets, good equity markets, good asset class markets. Can it or can't it? I mean, I don't know. And we've got Trump in the US, and we've got tariffs being imposed and threatened. We've got reactions and responses from Canada and Mexico and China. hopefully not Australia, because we haven't had anything dropped on us yet. What do you think about 2025? I find it quite confusing, but and in those cases, I usually just step back and wait. What do you think?
I think we've all been proven wrong multiple times in the last couple.
Yeah.
You made that point about the forecast for last year. And if you use US markets as well, like US markets were pricing in 6 rate cuts before June last year. And that clearly did not happen either. So markets are also wrong. It's not just pundits. It's people putting their money on the line going, I'm pretty sure this is going to happen, and still finding out they're not correct. So it's quite extraordinary how much has not played out the way we anticipate. I think the key things we're looking at as an organisation, as a bank, we've now priced in a rate cut for February, which is a pullback. We were expecting May. Now we're like, look, February looks like it's in play. I think the most important thing for people to recognise is the neutral rate, like where rates will probably land if the economy is okay, not amazing, but not dreadful, is much higher than maybe what people think. So you're probably talking about a neutral rate of like 3%. And then the bank will take a margin on top of that. So your mortgage, the most important thing I think people need to take away is those days of 2% mortgages won't ever happen again unless it's a crisis. We don't want a crisis. We've had one of those. It wasn't fun. So we do anticipate rates coming down, but not dramatically, not back to what it was before. You're still talking about a personal mortgage rate of, 5%, 4.5%, 5% at best, and that's probably 12 to 18 months away. But things change, so we'll see what happens.
But so NAB, you mentioned NAB has joined the other three in terms of the 18th of February. Momentum seems to be in favour of a rate cut. Money markets are saying the same thing. In fact, the money markets are saying a 95% chance of a rate cut. But I just wonder, and I don't know if this is right or not, but when I saw the trim mean the other day of the underlying inflation number, when you take out all those political moves that have been made to make inflation look like it's 2.4% when in fact it's closer to 3.2%, I think to myself, and given what's going on in America, and given the fact that the Federal Reserve of the United States has said, no more rate cuts for the moment, we're just going to hang out and see what happens. Do you think that we might be being a little bit premature relative to what the Reserve Bank Governor is going to announce on the 18th? Do you think there's a chance that she might say, look, just wait for the next set of numbers to come through, which I don't think come through to the middle of April or sometime later April, so to reflect the March quarter, which, by the way, won't be great politically for the government, the current government. Do you think that there's a chance that she might say that? Let's just have one more read on the inflation number. Let's see if it's still staying at 3.2 trim mean, or maybe even less. What do you think?
No, I think that's absolutely fair. The labour market's still really strong. We have 4% unemployment.
And that sounds good, but it's also a worry because
wages, we're still looking at sort of 3.5%, 4% max.
Yeah.
In terms of wages growth. That's very modest. That's not super inflationary. Your point about tariffs is really interesting, right? So Trump did say that he was planning a global tariff. Everybody gets hit by April. If that happens, that is a very good reason for the RBA to go, well, that'll be highly inflationary and very problematic for growth. And we would want to perhaps reconsider our position if that does get announced, and God knows what's going to happen, to be honest, given the news flow. So absolutely, I can see, despite our forecast changing, there are a lot of risks to that forecast, and you can see why central banks are being extremely cautious at the moment. They've got good reason to.
Well, it's because I guess it's not for us to argue, but we can certainly we can discuss this. You and I can just discuss this because it is dangerous for people to make an assumption and therefore make a decision off the back of the assumption that it's overwhelmingly rate reduction. And generally speaking, rate reductions don't happen one, they happen in a series. And I can't see right now, given the unemployment number, it's only 4.1%. Given the inflation, which is it's above 3%, GDP's not great, but it's not zero with a minus. It definitely does have a minus. We're not in a recession like New Zealand went into and other places and Europe went into. And we're not, relative to the rest of the world, our interest rate's not that high. Our official cash rate's not that high relative to the rest of the world. We didn't go up as much as everybody else. I sort of can see an argument that, I can see a delay. I think she probably would think, that's the Reserve Bank Governor, Michelle Bullock, would think, yes, I will probably want to do a rate reduction this year because we're heading in the right direction. But really, February, given all the other stuff that's going on, might be a bit difficult because last thing I want to do is put the rates down and not make another move after that, or alternatively put the rates down and put the rates back up. That's a really bad outcome. And I've got one set of numbers here which they gave to me at the end of January. But who knows what's going to happen in February, March, April, and particularly if I put the rates down, everyone might go nuts and start, like they did in the US, and start spending up big and feeling really confident. And this is an election year, so who knows what changes I'll be sort of running into in that regard. I don't know. I would have thought. I think. I won't go against the momentum, right? All the big four banks have said a rate reduction. I'm not going to go against it. But I actually think deep in my heart, I think, I should be saying deep in my brain, but that she might wait. If I was her, I would wait.
I think that's a very fair assessment of where we're at. I would add also, we just had retail sales and they were much stronger than expected.
And that's a worry too. Well, not a worry, but you know what I mean? It's not...
That tells you the consumer is maybe not as weak as we feared.
Yeah.
And therefore people are holding up. And maybe you don't need to rush into a cut. As you say, the worst case scenario for the RBA is what happened in the US, where they made a 50 basis point cut, which is sort of the big one, right? You only do 50 if you're really anxious about where things are at, prior to the election. And mortgage rates went the other way. They actually, so in the US, we have 30-year mortgage rates. It's not the same as Australia. So they're priced very differently in the market before they get to the consumer. But effectively, the market went, oh, that was the wrong decision. And we think rates are going higher from here. And so even though...
And we're right.
And we're absolutely correct. Yeah. So that's the worst case scenario. If you are a central bank governor, seeing a scenario where you've made a move and the market goes, you're wrong, and prices in the opposite direction, that's a terrible outcome. So there may be some anxiety off the back of that too.
Yes, she's sort of damned if she does and damned if she doesn't, to some extent. Because if she doesn't move, the government's not going to be happy, and I'm sure there's going to be a lot of discussion about it. And also the markets are expecting it. By the way, markets are pretty resilient. They will recover. It's not going to cause any major drama. But, the government won't be happy. So you're damned if you don't reduce it. If you do reduce it, by the way, and you make the wrong call, and it's, they're reduced by 25 basis points, but something happens overseas, or inflation starts to kick back in, or the retail sales keep going up, or unemployment starts going down, and then we start to get some proper wage pressure on employers, and wages go up, and retail prices go up, and prices reflect that increase. That'd be bad reputationally for the Reserve Bank as well. And there's a new board. Does the new board meet this meeting? The new Reserve Bank board, did they meet? This is their first meeting, I think. The new one that was appointed in December. Well, if I was on it, and I'm not, but if I was on the new board, I'd be going, well, I don't want to make the wrong decision, as opposed to saying I want to make the right decision. So maybe not making the wrong decision is making the right decision. So if I'm personally involved, I would be saying I'd rather err on the side of conservatism and not make the wrong decision, and therefore, as opposed to saying, no, we should put rates down, because that's sort of like the right decision. I think I'd love to see rates come down for our borrowers. I would love to see rates come down for our borrowers, your borrowers, everyone's borrowers. I'd like to see Australians get some relief on their mortgage payments. And by the way, we are talking about that 1/3 of the population, or whatever that number is, slightly less, 1/3. And we are talking about the 2/3 within the 1/3, so who are doing it tough. We're talking about the people who have got large mortgages, but maybe borrowed in 2022, and they borrowed at 3%. Or 3%, so let's say, or 2.99, or 1.99. Actually, it was 2% or 1.99. Those people are doing it really tough. I'd love to see a rate reduction for them. I'd like to see a series of rate reductions for them. I don't know, Gemma. I just I've got a feeling in the back of my head, like my gut feeling is she still hasn't seen enough information, enough data. And it is data. Maybe you could explain. Her decisions are not political. Her decisions are based on data. So maybe you could explain that a little bit.
Yeah, absolutely. So the RBA is an independent body, and it was set up with an independent charter very deliberately to ensure that they were not subject to political pressure. And you can see globally how it plays out. When there is political pressure, Jerome Powell in the US, Trump saying quite explicitly, I'm going to get rid of him, he's gone if I get in. Like, that's not a great scenario to be in if you're...
It's bad for markets.
It's bad for everybody, right? That uncertainty, markets hate uncertainty. So the RBA was set up with an independent charter and an independent board, and they make their decisions based on the data that's available. I mean, the primary objective is managing inflation, which for those of us who've been around for a long time sort of seems a bit funny because CPI was just comfortably in the band for close to 2 decades and didn't do anything very interesting. Australia was such an outlier. We only had quarterly inflation data. So every other country had monthly inflation data. We had quarterly. It didn't matter terribly much, for all of the 2010s and the decade prior to that, because inflation came in comfortably within that band between 2 and 3%, which is what they're trying to target. We did start getting monthly data, but the monthly basket, so the basket that they nominally go and collect and check the prices on, is mostly weighted to goods on the monthly basis. So it doesn't pick up services very well. So it doesn't necessarily pick up wage inflation very well. So you've made the point that they'll wait till April because that's when they've got the good data.
So given we're talking about that, is it all sort of pretty much a nonsense then, irrespective? Because they were calling for rate reductions last year. They were baking in a number of rate reductions during 2024, and it didn't happen. But irrespective of that, the markets, as you said, performed really well. The investment market I'm talking about, the markets to invest in. Is it sort of irrelevant, that conversation, other than for those people who sit in the mortgage belt? Does it make much difference? And should we just say whatever happens on that day? But if you're an investor, follow your plan, follow your strategy.
I think that's absolutely key. The very last thing you said is the most important thing. Yes, it matters a lot at an individual level. And it's really easy when you look at macroeconomic data to forget that it's people and it's their personal experience. And frankly, if you have a mortgage, the interest rate is critical to your daily cash flows. Like, matters a lot, and it can make or break you. But you do want to have a plan for if it rises to a much higher level than you expected, which is what happened to people 3 years ago. Or if it falls, and we saw people take advantage if it falls a great deal, having some flexibility and being really committed to your own personal finances to making it work is sort of the only thing you can do, right? You don't have any control over it. You can do your best to predict. The best is still pretty average at it. You really have to kind of keep a focus on what you can control and work within that.
So, and if you're a mid-level investor, like, maybe you've got a house, you've got a mortgage, you've got some equity, you've got some money in the bank, you've got your super, which is independent of everything because you can't touch it. Would you say to those individuals who reasonably good job, maybe family income might be 200, you might have a 1.2 children or whatever the Australian statistic is, do they still say those people a third cash, third equities, and third property? A third. Do they still talk about that stuff? Or around that stuff, around that territory?
Do you know what's really interesting? So I work with a lot of investors, and I work with our private wealth investors, people with lots and lots of money, and I work with people who are just starting out. Most people can never afford to get a third to a third to a third in Australia because property's so expensive. So they tend to focus in one area or another. It's really interesting how much people tend to concentrate in a field where they feel they've got some expertise. And I find that really interesting. So even though diversification is an amazing strategy, and the idea is that you have your assets spread across a range of different asset classes, and that you can then benefit if the property market is amazing and shares are terrible, at least you didn't have a terrible year. And if vice versa, you're still doing okay and you get that sort of blended return. Interestingly enough, in reality, it looks like people don't do that. partly because to buy a single property is just such an enormous chunk of people's wealth. If they're doing that, that's what they're doing.
And this is my final question for you, Gemma, if you don't mind. Is the a third sort of mentality, is that a mentality of not losing, whereas I'm just going to go on equities, and that's more a mentality I want to win. I'm backing these investments to win, whereas if I'm doing a third, I'm trying to make sort of balance things out. If something goes wrong, I've got something here. If something goes good over here, I made sure I'm in one of the categories. Is the Australian mentality, from your experience, do we invest so that we don't lose, or do we invest to win? Are we all in, or we just say, and let's just be nice and conservative?
So at the institutional level, your super fund, they're investing to get a little bit of everything and to be diversified so they can give you a consistent return. So I don't think you're trying not to lose, but you're going for consistency. What I find in people's personal lives is they're going for the one thing they feel pretty confident about. They feel like they can manage or control that, or they have more expertise in that than they do in something else. So I think it's really interesting when you look at what an institution does, your super fund, for example, where they're managing it for 100,000 people or 1 million people, they're going for consistency. You as an individual are probably going for what you feel good at.
And is that, when you say what you feel good at, is that what you learned as a kid? Not you, but is that something our parents did? Or is that something a financial planner told us about? Or is that something we have a great deal of interest in? We might love gold for some reason. What do you think is driving that personal or that private investor sort of enthusiasm about a particular asset class?
That's such a good question. I think it is that people gravitate to something that is of personal interest to them, right? Property people love property. Yeah. They love it. They understand it. It's tangible for them. Their dad might have been a builder. Their parents may have renovated a house. They really feel it quite strongly. Shares, love watching the market go up and down. Love the idea of being able to pick a great company over an average company. Love the idea of getting a dividend in my bank account. People have a feel for something and they love it. Crypto is not my area of expertise at all, but those who go for crypto, they feel like they understand it and they're passionately interested in it generally. I think most people are very reluctant to put their money in something that they're not interested in.
That's really interesting. I mean, apart from the fact that we have all these technical experts out there and financial planning people, and they ask you to, about your risk profile and everything, it's probably at the end of the day, people are investing in stuff they're interested in.
Yeah. And if you're going to a professional to get them to do it for you, they're going to do a whole lot of stuff that you might not understand and may not have a particular passion for, but that's what you're paying them for in the first place, right? Yeah, that's why they're there.
They're more the institutional style investors. They'll give you balanced portfolios, etc. Well, Gemma Dale, thanks very much again. And it's good to see that NAB's jumped on board with all the other three big guys, the four of you. I don't know where Macquarie is. I'd say there's five of you, I guess. And Macquarie's probably saying a rate reduction as well. I can't wait to see what our Reserve Bank Governor in her press conference says after the meeting. If it's up, it's going to be on. If the interest rates go down, it's going to be on. Everyone's going to be going crazy about that and expecting 3 or 4 more. And if there's no move, it's going to be on as well because they're going to say, why didn't you give us a rate reduction? Thanks very much, Gemma.
Thank you for having me.